What if I told you that the single most powerful tool for building wealth, the one tool that has quietly made many ordinary people financially free from salary, from side hustle, or any business is something that most people are too afraid to even try? Not because it's complicated, not because it's only for the rich, but simply because nobody ever sat them down and properly explained what it actually is and how it actually works. Today on Behind the Numbers, we're going to break down investing, what it really means, why it works, why so many people avoid it out of fear, and how ordinary people with ordinary income have used it to build extraordinary wealth over time. Hi guys, welcome back to another episode of Behind the Numbers, the channel where we go beyond the headlines to uncover how money, business and wealth really work. I'm Mel, and let's get into it. So let's start from the very beginning. What exactly is investing? In the simplest possible terms, investing is the act of putting your money into something with the expectation that it will grow in value over time and generate returns, which simply means give you back more than you originally put in. That's it. When you invest, you're essentially putting your money to work for you instead of leaving it sitting idle, losing value to inflation, as we discussed in our previous episode. Think about it this way. Imagine you have a certain amount of money. You could leave it in a savings account earning almost nothing while inflation quietly eats away at its value. Or you could put that money into assets like stock, real estate, bond, fund that historically grow in value over time and generate income along the way. Investing is simply choosing the second option, choosing to make your money work as hard as you do. And the most important thing about investing is not just that it grows your money, is that it does so using a force called compound interest, which, as we touched in our last episode, simply means the return you earn on your investment also earn returns themselves over time, creating a snowball effect that grows your wealth faster and faster the longer you stay invested. Now, before we go further, let's talk about the different types of investment because this is where most people get lost and overwhelmed. The first and most well known is stocks, also called shares or equities. When you buy a stock, you are buying a tiny ownership stake in a company. If that company grows and becomes more valuable, your stock becomes more valuable too. If the company pays dividends, which are regular profit sharing payments made to shareholders, you receive income just for owning the stock. The second type is bond. A bond is essentially a loan you give to a government or a company. In return, they pay you regular interest, which is simply a fixed payment for using your money over a set period of time and return your original amount at the end. Bonds are generally considered safer than stocks, but they typically grow more slowly. The third type is real estate, buying property either to sell later at a higher price or to rent out and collect monthly income. Real estate is one of the oldest and most reliable wealth building tool in human history. The fourth type is fund, specifically index fund and mutual funds, which are simply collection of many different stocks or bonds bundled together. Instead of buying one company's shares, you buy a tiny piece of hundreds of companies at once, spreading your risks, which means not putting all your eggs in one basket across many investments simultaneously. And the fifth common type is alternative investment. Things like cryptocurrency, commodity like gold and oil, and other assets outside the traditional categories. So why are so many people terrified of investing? If it's this powerful and this accessible, why do the majority of ordinary people never do it? The answer comes down to 5 fears that hold people back. The first fear is a fear of losing money, and this fear is understandable because yes, investing does carry risk, which simply means there is a possibility of losing some or all of what you put in. But here is what most people don't understand. Not investing also carries risk. The risk of inflation destroying your savings, the risk of never building enough wealth to be financially free, the risk of working until you are physically cannot anymore because you have no assets generating income for you. The risk of investing is just as real as the risk of investing. It's just slower and less visible. The second fear is the fear of not knowing enough. Most people feel like investing in something that requires a finance degree or special insider knowledge. But the truth is the most successful long-term investment strategy in the world. Simply buying diversified index fund consistently over a long period of time requires no special knowledge at all. The third fear is the belief that you need a lot of money to start. This is completely false. Many investment platforms today allows you to start with the equivalent of a few dollars or naira. The amount doesn't matter nearly as much as the habit and the consistency. The fourth fear is the fear of being scammed, and this one is legitimate, especially in developing economies where get rich quick schemes and fraudulent investment platforms prey on people's financial desperation. This fear has caused many people to avoid or investing entirely, which is like refusing to ever drive a car because some people drive badly. The fifth fear is simply initial, which means the tendency to stay where you are and not do nothing because starting something feels uncomfortable and overwhelming. Most people have never invested, does not want to do that because of a specific fear, or simply because they have never taken the first step. And the longer the wait, the more normal investing feels. Now, let's talk about the principles that make investing work, because understanding this will change how you think about money forever. The first principle is time in the market. Beat timing the market, which simply means the longer you stay invested consistently, the better your results will be, regardless of short terms up and down. Many people try to wait for the perfect moment to invest, when the prices are low, when the economy looks stable, when they feel more confident. But the research consistently shows that people who invest regularly, regardless of market conditions, almost always outperform those who try to time their investment perfectly. The second principle is diversification, which simply means spreading your investments across different types of assets, different industries, and different geographies, so that if one investment performs badly, others can compensate. Never put all your money into one investment, no matter how confident you feel about it. The third principle is consistency over intensity, which means investing small amounts regularly every month is far more powerful than investing a large amount occasionally. This strategy is called dollar cost averaging. This simply means buying investment at a regular interval regardless of price, so that over time you naturally buy more when prices are low and less when prices are high, averaging out your cost and reducing risk. The fourth principle is patience, because investing is not a get rich quick strategy. It's a get rich slowly and sustainably strategy. The investors who build real wealth are the ones who stays the course through market downturns, resist the urge to panic sell when prices fall, and trust the long-term process. So what should you actually do right now if you want to start investing? The first thing is to educate yourself, and watching this video is already a great start. Understanding the basis of what you are putting your money into is essential, because before you invest a single naira or dollar, the second thing is to start small and start now. Don't wait until you have a large year or a large amount saved. Don't wait until you feel completely ready. Start with whatever you can afford consistently. Even a small amount invested every month will grow big over years and decades thanks to compound interest. The third thing is to use regulated and legitimate platform, meaning platforms that are officially licensed and overseen by financial authorities in your country. This protects you from scams and ensure your money is handled properly. The fourth thing is to think long term. Investing is not about making money this month or this year. It's about building wealth over 5, 10, 20 years and beyond. Every time you feel tempted to pull your money out because of short-term market movements, remember why you started. Financial freedom, wealth building, and a future where your money works for you instead of the other way around. In our next episode, we are going to bring everything we have learned so far together and answer a question that millions of people ask every day. What is business and how does it actually make money? Because understanding business is the next critical piece of wealth puzzle business. If today's video finally made investing feel less scary and more accessible, please like, subscribe and share it with somebody who has been putting off investing out of fear. Because remember, the numbers don't lie, but they do hide. I will see you in the next one.